Hello, welcome to another episode of Creative Real Estate. Today, I'm super excited to have Jeremy Nussbaum on the call from Walker Dunlop. He's going to be taking us through a little bit about his background, his financing experience, a little bit more about the company itself, and what's going on the markets today. So, welcome to the podcast, Jeremy.
Really appreciate you having me. Hello to everyone watching. Appreciate the opportunity and the platform. Looking forward to it.
Absolutely. Thanks for being our guest today. So, let's start off with yourself. How did you get into the space, and what's Walker Dunlop like? Give me an explanation of their platform.
Sure. So I actually started on about 2004, 2005 on the residential mortgage side. Really enjoyed that as well. Certainly very different, dealing with more of your everyday borrower rather than a sophisticated, real estate investor. Did that basically kind of through the early stages of the great financial crisis till about 2009, 2010, and then transferred over to the commercial side a couple of years thereafter. In about 2012 or 2013, I think. So I've been on the commercial side now for 7+ years. Actually got to my first company, Deerwood Real Estate Capital, through my boss, who I had already been playing ice hockey with, interestingly enough. My brother, who's a real estate attorney, suggested I ask him about any opportunities, and it's so far so good. So we were at Deerwood. We were a smaller boutique capital markets advisory platform, and then about 3.5 years ago, we were acquired by Walker Dunlop. Walker Dunlop is one of the largest agency lenders in the country. We've been number one Fannie Mae. I believe it's 9 out of the last 11 years.
Oh, wow.
And we're consistently a top 3 lender for both Freddie Mac and HUD. 2019, we were 3 on both those lists. I think doing about a combined $20 billion in originations through those 3 platforms. So for a guy like myself, coming from the capital markets background and really placing debt with third-party providers, it's been a fantastic value add to my platform and my business to now also have direct capabilities. So it's been great.
So in terms of, you got started in the resi space and then you moved across to the more commercial. And if I understand you correctly, that was sort of through an interaction of where you were playing hockey before, right? So it was like a sports move. You happened to have this rapport with someone and were basically able to make the jump across into commercial. Was a large draw on that, like wanting to just step up your game to, how do you take this thing to the next level? What was the thinking behind it?
So, I really had kind of gotten out of the residential business during the great financial crisis. So I very into sports and athletics. I was doing a few different things in kind of the fitness world, but was looking for a little bit more of, I would say, a business career. I think by trade, a little bit of like a natural salesman kind of guy. I love to talk to people and interact. So it was really great. I still remember sitting down, across from my first 2 bosses here in the conference room. We're still in the same space, just down the hall, and it's really been great ever since. Yeah, it's always interesting when you know someone first in a non-business relationship, and then obviously you come over and now all of a sudden they're your superior and so on. But through and through, starting off as Deerwood and now Walker and Dunlop, this office in particular has been really full of really great people, and it's been a fantastic working environment. And ultimately, when you're in a position like the one that I'm in on the sales side, you make your money. So
you eat what you kill.
Exactly. So get out there, be hungry, hustle, do whatever you need to do, scratch, claw, dent. Commercial mortgage business is competitive. Not for everyone. It's, you're starting out, you may not know that much. You're not great on the phones. You're butchering phone calls and opportunities. You're letting them slide right through your fingertips.
Yep.
Right. You're counting your commission checks when someone says you a T12 and a rent roll, and you're 90 days from even thinking about closing a loan.
Yeah.
But it's all about the long game. And, fortunately through lots of tough lessons and difficult situations, circumstances, it's been a fantastic run, and have no intentions of stopping anytime soon. I'm very fortunate to be one of the ones who really love what I do.
Absolutely. And I mean, it looks like you're pretty active in the market as a whole. So Walker and Dunlop, they're specifically multifamily, right? They don't do any other sectors of real estate, or do they?
So on the lending side itself, in terms of us being direct lenders, we
Yeah.
are just multifamily. So our platforms include Fannie, Freddie, HUD, and we also have a balance sheet for more transitional deals. The balance sheet is, I would say, mostly used for new construction lease up type plays or
Okay.
lighter value add opportunities. My background being on the capital market side,
Yeah.
uh, a significant portion of my business is still using third-party capital providers,
Okay.
and I'm very active in other asset types as well. Currently doing several industrial deals, retail, office, no hospitality at the moment. That's, I guess, for a conversation a little later on
Yeah.
in this chat, but still certainly staying extremely active across all sectors. And, we've really seen it pick up here in the last little bit.
Great. Yeah, I just wanted to dive into that too, just to get an understanding of everything that you can do. When you say on your balance sheet, maybe you can just elaborate on that for anyone that's kind of new. When you tell me that, essentially what you're saying is the company has its own funds to deploy on loans as opposed to going through third parties. Is that correct?
Correct. Right. So any kind of Fannie, Freddie, and HUD transaction, we're essentially going to fund the loan, right? And we've got government-backed agencies, and we're going to securitize those loans and sell them off. And we service everything we close. So our servicing portfolio, I believe now, is about $95 billion in assets across the country. So,
Okay.
whenever I get, any kind of multifamily deal, we're very lucky and fortunate to have tremendous amounts of information at our fingertips, whether it's expense comps, great rent comps. Um, we've got a tremendous amount of resources. When it
Yeah.
comes to the balance sheet, yeah. So we actually have a JV with Blackstone. So they're
Okay.
our partner. They're our partner on the balance sheet. And yes, it's both us and Blackstone who are kind of making the credit decisions, and we fund those loans. So we are the lender, and we will also service and we'll fund future draws. So everything's fully internal on those transactions, and those deals are typically meant to be a feeder to Fannie, Freddie, or HUD. And the idea
Okay.
is that those deals are just not fully stabilized yet, and we want to take them either through the lease up process or just a little bit of seasoning, whatever it might be. Or as an example for a HUD transaction where we just need the amount of time that's necessary to get a HUD loan closed, and you're typically not going to get that on your typical PSA timeline.
Okay. And I would assume, obviously, every single deal is unique, but typically speaking, you're going to not so obvious. That's what I'm asking. But I would think that you're going to be paying some kind of a premium over your third-party debt once the asset's been stabilized for taking on that extra bit of risk. So if you were to go the balance sheet route, you would normally have a slightly higher rate and shorter terms. And what does that really look like?
Yeah, so I mean, it happens to be extremely flexible money, which is really great, especially for the kinds of assets we're typically getting involved with. So, I mean, we'll do super short-term deals. If you're buying a deal at a construction that's 75% occupied and you've only got, you think you've got 60, 90 days to get that thing up to 90% and be ready to go, we'll do a 3 or 6 month loan
Wow.
with a very short minimum interest period, really just to bridge the gap to agency. And one of the things that we do when we do these loans is we actually underwrite them through the agency model.
Okay.
So we're basically just gearing it to get ready. But yes, it's going to be a short-term loan. We'll go out typically as long as 3 years plus a few extension options on kind of your more typical transitional value add deal. Maybe there's some rent bumps through some renovations that are going to be available, and your plan is really to get in there and start turning units as they become vacant and
Yeah.
push rents. So we'll go out for as long as up to 5 years.
Okay.
And, terms are a little bit of a wider gap in today's market. I'd say, pricing probably starting somewhere in the mid 300 over LIBOR range,
Yeah.
going up to maybe 500 over LIBOR for a more difficult, more transitional type asset, interest
Okay.
only, non-recourse, and we, especially if it's a short term, we really try to limit the fees to reduce the cost to our borrower, because, the idea is really just to buy some time to
To
get
get into
that deal
something
into the
permanent.
agencies.
Yeah. Yeah.
Yep.
Okay. And while we're on that topic, I mean, what are you seeing right now in terms of agency debt? What are the spreads like, just as a comparison over balance sheet?
Yeah, I mean, pricing is amazing right now on the agency side. I have an application out right now on a deal just outside of Dallas. It's a 10-year loan. Fannie Mae offer 1 year of interest only at 2.99%, 76%
Wow.
loan to value. So we're seeing really, really aggressive money. Pricing is super, super tight. And it makes a good deal really great, right? Because it's really going to
Yep.
help those numbers. And obviously having really tight rates is going to help us give us the ability to get higher leverage and squeeze under whatever debt service coverage ratio threshold we're working under. So if it's 125 or 130.
Yep.
So pricing is really great. For a little while, I would say up until about 5-6 weeks ago, Freddie Mac was kind of out of the game for a little bit. They were
Okay.
more on the sidelines on a kind of a wait and see approach.
Yep.
But they've really come back pretty strong. And obviously there's a misnomer out there that Fannie and Freddie are one entity. They're competitors. They look to beat each other and win transactions. And, it's our job here at Walker Dunlop to make sure that we create that competitive environment, both through the agencies and other capital sources, to make sure that, every client's getting the best deal that fits their business plan, which is really what's important, because as you said earlier, every deal is unique.
Yep.
We're seeing more IO out of Freddie right now than we are out of Fannie.
Okay.
Sorry?
No, I'm just acknowledging what you're saying. Sorry.
Oh, yeah.
So when you say
We
more IO, what are you seeing? Like 5 years versus 3 years, or?
Yeah, you can. I mean, 5 years of IO on a Freddie 10-year deal is definitely attainable.
Okay.
And again, I'm talking about kind of the higher leverage thresholds right now. So,
Okay.
we're up in the 70s, up to 80%.
Are you still getting some loans approved up to 80%?
It's out there for the right deal.
Okay.
Yeah. So the agencies, still have their reserve requirements, although they've definitely softened on those requirements. We're typically seeing about 9 months of principal and interest and kind of your standard transaction above $7.5 million, something that fits into the conventional platform.
Okay.
You are seeing some longer reserve requirements and smaller transactions.
Okay.
And that's really just simply a numbers game. If you go look at the deals that have needed the most help, whether it's forbearance or have had more foreclosures and things like that, it's typically
Being the
on your
smaller
smaller
operators.
transactions.
That's
Yeah,
interesting.
you're typically dealing with a smaller, maybe less,
Less
well-heeled
sophisticated and,
investor.
yeah, well
Yeah,
capitalized.
I don't even know if it's less sophisticated. They just may not have the same kind of pockets, right? Just getting
Yeah.
going. Their
Yeah.
investor base may not be as strong. So the agencies are obviously trying to protect the downside there. But we've definitely seen some softening. When Fannie Mae first came out with the reserves, they were requiring principal, interest, taxes, insurance, and capital reserves on every transaction for 12 months.
Yeah.
And they've since come off of the taxes, insurance, and capital reserves. And now we're also seeing, as an example, through Freddie Mac, if you have, let's say, a 5-year interest only period, you can go into Freddie and request a waiver to just have interest only be reserved. Because
Yep.
the reality is, why are we reserving principal and interest if my payment's only interest only, right?
Yeah.
If you're worried about my ability to make my interest payments, you shouldn't also be collecting taxes, insurance, and capital repairs.
Yeah.
So
It's crazy.
we
Yeah.
have seen the agencies kind of scale back. And again, that's really all due to obviously the positive collections that we've seen over the last 4 months.
Yeah. So let's touch on that for a second. You've covered a few different things there that I want to pull back to. So um, obviously just over COVID, we were getting pricing on another deal at that point in time, and interest rates rocketed while like Treasury was dropping rates, right? So your borrowing rates or your all-in rates actually went up, even though the reserves and Treasury was kind of bringing the rate down.
Yeah, way
And
up.
that, yeah, way up. Yeah, it was kind of scary to see it happen over the week and a half. I think anyone that rate locked just before that was thanking God, and anyone that missed the boat was kind of wondering what on earth they were doing. So, um, with regards to that, there was pretty much a reaction to would it be fair to say, let me ask rather than tell because there's a good chance I'm wrong, but would it be fair to say that they were just pricing in the risk there and the unknown and they wanted a higher yield for that as a servicer, or where was that coming from?
Yeah, no, I mean that's exactly it. So, right, I mean we have these mortgage-backed securities that get put out on the market for a B buyer to come in and buy those securities. And when COVID kind of came, and this is really right around the second week of March,
Yeah,
we saw spreads. I mean, as you said, completely blow out. Coupons were north of 5%.
yeah,
So we're talking different stratospheres in terms of the ability to borrow,
yeah.
and that really continued for a couple of weeks. And the what really kind of saved the agency platform in that interim, and what really added liquidity to the market, was the Fed stepped in and started buying these agency mortgage-backed securities. And
Okay.
once the Fed stepped in and started buying these loans, pricing came way down. I mean, we're talking like 75, 100 basis points within a week or two.
Yeah.
And then as the Fed stepped in and started buying some of this paper, some of the other buyers of this paper came back into the market and continued to compress spreads. And that's really what we've seen. And we've actually seen the Fed buy less and less paper, even though they're still in the market. They're
Yeah.
now getting out. They're not getting outbid by
Oh
some of the
wow.
other buyers in the market. So they
That's
actually
interesting. Yeah.
haven't won as much of the business as they've been looking for. But that creates fantastic, healthy competition out in the marketplace, and that's
Absolutely.
obviously helping guys like myself
Yeah.
and guys like yourself on the buy side by
Yeah.
really keeping spreads down and coupons down.
So I'm curious, with you working in different sectors, are you seeing that spreads are coming down across all sectors other than the obvious ones that have been hit, like probably some level of retail, and then definitely on the hospitality side, I wouldn't expect their spreads to have been reduced. But would you say the institutional investment at that level believes in the strength of the multifamily market as a whole, or have you seen it across all sectors that spreads have come down and become more competitive?
Yes, I mean, I'll touch on the most difficult ones to start. I mean, hospitality right now is, I mean, to say difficult is an understatement. I can tell you that I didn't go to market on a hospitality deal, but I made a few phone calls on a larger size deal here in Manhattan. And I wouldn't say I got laughed off the phone, but it
It was
was it
close.
was pretty it was pretty close to that. So it's definitely, anything in hospitality right now is going to be extremely, extremely tough. On the retail side, it's just guys being extremely particular. So standalone groceries, Home Depot, Lowe's type home improvement stores, any kind of pharmacies. You can still certainly get those done.
Yeah.
Leverage is definitely dialed back, but seeing coupons in the low fours or high threes at the right leverage levels certainly
Okay.
attainable. So
Okay.
pricing is still extremely attractive. I can tell you, I was working on a single tenant Home Depot deal, which we have under application with a CMBS lender. The deal got put on pause the second week of March when all of CMBS pulled out of the market.
Yep.
And we are now back engaged in the transaction, and our terms are eerily similar to what they were pre-COVID. We've
That's
got an
interesting.
extremely well-performing store in a fantastic location in a really strong market, and the market is strong for that asset. So that deal is being treated really, really well. And you are even seeing some, I would say, more traditional grocery anchored shopping centers that have some other shop type space.
Okay.
They're financeable, and they're financeable pretty good rates. Again, leverage is definitely going to be lower than where we were before.
Okay.
What a lot of lenders are looking for now are, what we now call essential retail.
Okay.
Can the center survive on just the essential income that's coming from those tenants? So
what falls into that bucket?
Pharmacies,
Okay.
supermarkets, home improvement stores, dollar stores have pretty much across the country have been open through most of this time.
Yeah.
There's not a ton more that fits that list.
Okay.
But anything that might be potentially deemed essential, or again, if it's just a grocer, then they want to make sure that the grocer can kind of, at least handle debt service and keep the property in solid shape if we were to go through another shutdown type situation. And obviously, one of the big things that everyone's looking at now in all sectors, how have collections been?
Yeah.
And obviously, retail, it's been much more troublesome than things like multifamily or industrial. The industrial deals I'm working on right now, it's the sexy asset, sitting right next to multifamily in today's market. So,
well, what would you say are the sexiest sectors? I mean, is it multifamily and industrial? Is that what you're finding based on COVID?
Yeah, 100%. I'd say probably third is maybe self-storage.
Okay.
We're going to see how that does. Maybe if there's a consistent move out of kind of city living and people move more to suburban life, maybe there's not as much of a demand for storage space. But just to kind of, I guess, backtrack before we get there, I'm working on a couple of office transactions, both out of state and here in kind of suburban Jersey. So, there's a lot of belief that suburban office is really going to make a nice comeback, and people looking to get out of, being in elevators going up 36 flights, in the middle of Midtown.
Yeah.
Where if you want to take the stairs up 2 or 3 flights, it could be potentially a lot more comfortable. If you want to grab your lunch break and go sit on a bench outside the building instead of having to, fight through hundreds of other people exiting the building en masse to go, pick up their food.
Yeah.
So there's a lot of prevailing thought that maybe people aren't going to give up their space in the city, but they're going to look for some alternative space as well. People potentially will need to expand. People will need to expand maybe their footprint in the office sector in order to keep more social distance and keep their employees comfortable. And listen, at the same time, I'm sure you're going to have other companies who said, "Hey, we've been working from home for the last 4 or 5 months.
It's working.
Everything is functioned just fine. We can continue this. We can reduce our overhead and our cost." So, it's going to be interesting to see how the office sector evolves. I happen to be of the belief, I think net, it will probably all equal out.
Okay.
But it's definitely an interesting time as things continue to evolve. But the money available for office, it's available. Again, it's slightly scaled back, and guys are definitely taking closer looks and seeing how collections have been. But in general, office collections have been pretty strong as well.
Okay. And the other thing that I wanted to peel back to was you mentioned that the Fed is being outbid by some competitors in terms of pricing on these loans. Who competes with them? Like, let's assume I've got no background in how the debt markets work when it comes to real estate. Can you elaborate a little bit more on that whole backstory?
Sure. So, it goes this way: CMBS, commercial mortgage-backed securities, agency mortgage-backed securities, as well as CLO execution, which pre-COVID was a really a market that has been expanding significantly over the last couple of years.
What is that? Say that again.
The CLO market. It's the
CLO.
securitized bridge loans.
Okay.
So again, for transitional type assets, these deals are getting packaged in pools, and sold off in large chunks. We're talking, hundreds of millions of dollars going north of $1 billion in these packages.
Okay.
And they basically work the same way across all sectors. You have different investors, and obviously these are very, very large groups who are coming in and able to buy, $1 billion worth of notes, and take them down. And obviously, any agency lender or any CMBS lender, we're trying to sell these loans at a profit, and that's how we make our money.
Yeah.
And when we when you kind of get through it, so you have these big, massive companies who are bidding on these packages, just like, the regular average real estate player is bidding on an asset. So here you have just much larger companies bidding on many, many assets all at once. And, it becomes a pricing game. Who's going to pay me the best price for my package of loans? And that's likely who we're gonna move the paper to.
Got it. Okay, so coming back to the current market environment post-COVID. So you've mentioned that the winners, in your opinion, are industrial, multifamily at this point in time. There's some other guys that are possibly going to come through as winners too, but time will kind of tell. A lot of that's maybe speculation at this point. When it comes to some other changes in the market environment, I'm curious to hear if lenders are valuing properties any differently to what they were pre-COVID. Have you seen any change in valuation as far as cap rates are concerned from a lender perspective, or has everything stayed pretty much the same?
So I've been doing a bunch of work in terms of value on an industrial deal we're working on. It's a refinance. We financed the acquisition back in 2017. The sponsor's done a really great job of moving some tenants around, executing on some long-term leases, being able to push rents up to market, and so on. So, one appraiser I spoke with thought maybe we were 25 basis points in the wrong direction on a cap rate valuation basis.
Okay.
Excuse me. And we're seeing, I would say, similar type talk on the multifamily side. I'd say maybe anywhere from 10 to 25 basis points on a cap rate basis.
Okay.
It's nothing really significant. I've spoken with other appraisers, who said, hey, collections are just as strong as they were pre-COVID. We're continuing to see things trade at, pretty tight caps. I have no reason to give it any kind of COVID discount, so to speak. Yeah. So, I don't think there's one real answer to that. We're seeing either a little bit of movement or no movement at all.
Okay.
We certainly are not seeing any kind of drastic change in valuations, either from the lender side or on an appraisal side. Now saying that, certainly lenders just in general, forget the valuation aspect of it, have reined in on their appetite for risk.
Yes.
And, look to be a little bit more cautious on transactions and, maybe do a little bit more homework than they would have done previous.
Got it. And I mean, with the interest rates, have you seen rates lower than this in your working history?
I've not. I can tell you, I never thought I'd put out an agency application at sub 3%. And there's even cheaper money out there. I mean, if you start bringing leverage down to 55, 65% LTV, pricing's coming way down. I have a HUD loan signed up right. I have a HUD loan signed up right now, and we priced it at 275. It's all in, including MIP. And our pricing right now is probably inside of that. Wow. Just quoted a HUD construction loan, and we're in about the 3.5% range on that transaction at 85% loan to cost.
It's remarkable.
Pricing is, I think remarkable is the word. It's, if you could find the deal that makes sense in this market, it's a fantastic time to be a borrower.
Yeah. Yeah, it's interesting you say that, because I think a lot of us, myself included, have kind of been sitting on the sidelines to a large extent, thinking when are things going to start to drop off? Because as we discussed just prior to going live with the podcast, is there hasn't been much of a pricing change. Expectations are where they were before. People aren't being foreclosed on yet. There hasn't been any distress. Collections have been good, specifically in the multifamily space that was. And so, you take that in combination with the fact that rates are the lowest they've ever been. I don't know if sitting out of the market, if you're just going to miss the ride over the next few months, or whether this is the perfect opportunity. And I suppose in a year's time, we'll look back and think, oh, we missed it. Oh, it was a great call. In hindsight, will be 2020. But for me, it's an interesting viewpoint, is because just afterwards, I mean, spreads went up wild. So there was no way of understanding where things were going to go and what the future was. And it was clear that even the money was reflecting that. Whereas now they're reflecting a high level of confidence. Collections have been great. Obviously, there's been stimulus on various fronts from both the lender's side and from the tenant side. So it's maybe artificial, but, is it going to hold up or not? And I think that's the big question. What's your viewpoint on all of this?
Yeah, I mean, I think the only aspect of that is, the belief, I think, has to be that interest rates aren't going anywhere anytime soon. As long as we're not pricing in the unknown risks, which is really what happened at the beginning of COVID, right?
Yep.
Just nobody knew. I mean, we still don't know. We still don't know that much. We think we do, but we really don't. So that was really just unknown risk. Right, but we certainly don't think we're seeing any kind of rate hike anytime soon. I don't think we're going to turn around tomorrow and we're going to see a 10-year U.S. Treasury at 185.
Yeah.
So the prevailing thought seems to be the interest rate environment today should seem to hold for some time. What exactly that means, we're not sure. At the same time, we're still. I mean, the market is telling us that there seems to be a lot of comfort and certainty, but like you said, as we discussed, before we went live here, it's a little hard to believe that there's not going to be any pain from what the globe. I mean, forget just the U.S. what we've gone through, as a society here, and like you said, there's been a lot of artificial money pumped into the economy to keep everything afloat, whether it's stimulus checks, PPPs, forbearance, payment plans being given by landlords to tenants. The agencies continuing to give or extending forbearance for those in need. So, at some point, there's gonna have to be some pain. And we don't know what this next HEROES Act is going to look like. What's going to be fully involved there? It certainly seems like the $600. Weekly federal government unemployment is going to be gone. Okay. You had many people earning more sitting on the sidelines, not working than crazy, right? It's not a great way to get people back to work.
No, that's for sure.
Right. Yeah. So, and I think that's the impetus for removing that. And there's been talks about a second round of stimulus checks. There's been talks potentially about rent subsidy. Ultimately we're sitting here, it's July 14th, and the people who sit in Washington are telling us that they want to get something done within the next week or two, but we don't really know what that's going to look like and how long that's going to last. So it's going to be interesting as these things all kind of time out. Do rent collections stay in that, 90, 92, 95% range? And if we see a decrease, down into the 70s and the 80s, is this going to be a severe domino effect that's going to lead to, a need for significant forbearance requests, foreclosures, and obviously more significant distress? And there potentially in lies opportunity for guys like yourselves, and people out there who are looking to be opportunistic.
Yeah, absolutely. And that leads me into sort of the next question that I had is, you guys are obviously sitting with a massive lender's book. What have collections been like across all of that? Has it been fairly steady? And how many of your borrowers are potentially sort of entering some level of distress or have requested forbearance? What have those numbers been like?
So collections really across the board have been really strong. We're seeing the same data that you're really seeing from everyone else.
Yeah.
Where collections have really, stayed pretty consistent. Obviously they're all a little bit market dependent. I mean, I sit here just outside of Manhattan. Collections in New York City have been worse than in most parts of the country.
Yeah.
But 90, 92, 94% collections really, it's been extremely consistent.
Okay.
We've had many inquiries and questions about potential forbearance, about what options and availabilities are there. The actual forbearance requests that have been put into place and that have been granted and that are in play are a tiny, tiny percentage. We have obviously continued to see it climb as this has continued to drag on.
Would you
but
say
it's still
less than 3% or?
Yes.
Yeah.
Less than 3%. I'm not sure of the current number, but it's really a very, very small number. It's a very small number. We'll see what happens here, over the coming weeks and months as this continues to evolve. But, as of now, it's really, it's been really small. And many of the borrowers who came to us up front asking for a forbearance, who got forbearance, are now actually in the process of coming out of it.
Yeah.
And either paying back the forbearance that they took, or starting on a payment plan to get current over, the next 6 to 12 months. Right. There were also a lot of regulations put into place that if you took forbearance, there's no late fees and there's no evictions, and there's a lot of other things that could hamper property operations. So a lot of borrowers are going to do what they can to get themselves current so that they can operate their property more efficiently.
Yeah. Or try avoid it altogether. I mean, the last thing you want is a property that isn't performing because of lack of collections, and then you go for forbearance and you can't evict the people that aren't paying the rent. It's like, it's not a great cycle.
No, right. Right. You go and you tell a property owner or property management team that you can't evict people for 3 months, 6 months. That's a very, very difficult way to operate a property, right? There's no threat to your tenant who's not paying their rent, right? Well, what are you going to do to me? I'm not paying you, on the 1st or the 15th.
Yeah.
Forget it.
And it just creates a very good environment for the blame game between owner and manager and tenant and lender or borrower. So, not an ideal route, I suppose, to go.
Definitely not.
In terms of financing right now, you kind of touched on it a little bit at the beginning where you were saying anything under a $7 million loan is being treated slightly differently and a little more strict as opposed to things 7 million plus. And that kind of steers me into my question around where do you see the most value in the market right now for people in the space or wanting to get into the space from a debt perspective? So where are you seeing the best terms being issued? What do they look like? We've obviously touched on some of that right now, but is there maybe a better opportunity for people to get better pricing in, call it the $7 million or less loan range than there is higher up because of the fact that debt's more difficult or because of the fact that those operators are facing a little more difficulty? Maybe you could just elaborate a bit on your thoughts around that.
Yeah, so, I think there's definitely going to be more opportunity in that space. If there's opportunity really, anywhere in the multifamily sector, it's probably there for people who are just maybe very tight on cash or over leverage themselves to get into a transaction. Maybe they overpaid, feeling the market, was on such a great run that it's going to continue, and they were really, they were buying upside that maybe they're not going to be able to see with any kind of, rent growth within the next, 12, 18, 24 months as we kind of climb out of this. So in terms of opportunistic, sure. I would say that there's probably more opportunity on the smaller deals, and there's also more leverage to go to a seller and say, hey, my debt is not as attractive as my debt on larger deals. My pricing is a little bit worse. They need to hold more reserves. Yeah. So, it gives you another opportunity to go back to the seller and say, hey, I can't pay you the same kind of cap that $12 million deal sold at down the road because this is a different deal. So in terms of opportunity, I would say there's probably more opportunity on the smaller deals. In terms of where the best debt lies,
Yeah.
that's going to be it, on larger transactions. And again, as we discussed earlier, if you go further down on the leverage side of things, I mean, we put out a quote on a 55% LTV deal, 10-year deal, 10 years IO at around 2.65% through the agencies. So, if you have the ability to borrow, less, and, that deal has some affordability to it, which creates even better pricing. I mean, it's for free money.
Yeah, it's pretty close. And I think that's why pricing's been so competitive, to be honest. If you look at it across the landscape, just from more of an asset manager's perspective, is bonds are pretty much out the door at this stage. Cash is basically negative. And so your only alternative really is either the other alternative is equity. And I think that's why you see the equity markets are so inflated from a stock market perspective and almost back to pre-COVID levels as of today, at least. Whenever people are listening to this, it might be different. But for me, that is like
crazy,
mind-blowing, because they're just kind of assuming everything's back to normal and the world will continue and forgetting all the losses that everyone's just incurred and continuing there. And I think for any asset manager that's looking for some kind of a fixed income, housing's not going anywhere. There might be some level of stress in the market and it's going to be more difficult for people to afford their rents. But when you're in the affordable housing market, there is no alternative. And if you think about COVID, where did everyone go? It wasn't the office or retail or medical, unless you actually were sick. It was back home, like to where you live. And
shelter in place.
That's it. So for me, I think there's such a safe case story, even if you're maybe not going to see the rent growth because everyone's struggling. The reality is people don't have an alternative. And if you're looking to place capital somewhere that you're at least getting some kind of a dividend yield and possibly some upside, I think that's a place to do it. I think most of the other alternatives from an asset class perspective are just dismal right now.
Listen, we've seen the stock market, just take yesterday. So today's the 14th of July. Yesterday, I think early in the day, the market was up about 500 points or 400 plus points.
Wow, yeah.
And at the end of the day, I think the market closed at up 10 points. So, what we're seeing in terms of volatility, right? You get a bit of good news about, a drug for COVID-19, and then you get some kind of bad report and there's a massive sell-off, and the immediacy of the reaction, kind of across the board, it's almost even mind-boggling, right? Short-sighted nature of what we're seeing going on in the markets right now is it's crazy. We've never seen these kinds of swings on the daily. It's quite interesting.
Yeah, no, absolutely. Okay, so what I wanted to get into from there is kind of we dealt with size. Are you seeing any differential between classes or strategies as far as financing is concerned? I think you touched on the fact that if it's an affordable deal, maybe pricing's a little bit more attractive. I suppose they want to just sort of prop up that market and create housing. What's the story over there?
Yeah, affordable is always going to be, treated better by the agencies. The mandate for the agencies is to finance, affordable housing. So that is really what they were created for and what they were put in place for. So whether it's affordable just by a rent perspective or whether it's affordable through some kind of property-based affordability, Allura or anything like that, you're definitely seeing a price adjustment there. The agencies have also come back now with green financing, where if you're going to make improvements to reduce your carbon footprint, and that could be both through water conservation, energy conservation, we're now again seeing in reduced pricing for that. So you can see anywhere between even 10 to 20 basis points for green financing. And that, requires the sponsor to spend some money on the improvements. That could be, low flow toilets, shower heads, LED bulbs, different things of that nature to, help reduce the carbon footprint. Obviously, in the long run, will help the borrower in terms of operating costs and be able to manage those. So that is really back in the market. That had kind of gone away for, say, it's got to be the last maybe 12 or 15 months. Okay. And we've really and the green program is really now kind of back in full effect. So we're gonna start to see a lot more of that money get put out the door. But I think those are really the two biggest aspects or movers right now in the market, specifically for the agencies in terms of pricing.
And what's the viewpoint from agencies when every single person in the multifamily market, other than maybe DST money, was looking for this value add play. And obviously, I don't think anyone's sort of thinking right now, let's go and renovate for $10,000, hopefully get a $200 or $300 rent bump, underwrite that to the rents and increase the value. Do you find there are people doing that? What's agencies' viewpoint on that at this stage? Because
sure.
I would think ask.
Yeah, to touch on the bridge market here in general, because I'd say it's not something we've touched on yet.
Yeah.
That is the market that's really come back the slowest in terms of, your typical value add type play, and that goes across the sector for office, industrial, retail, multifamily, whatever it might be. I'm doing a deal right now down in Memphis, and we scoured the market through and through for bridge money. Client is buying a large property north of 550 units. Wow. Memphis can be a tougher market even in good times.
Yeah.
Certainly in times like this doesn't make it any easier. We're doing a pretty attractive deal. It's north of 70% loan to cost. We have a renovation budget of, we're about $5,500, $6,000 a door. There's a bunch of down units that need to be brought back online. So we are still seeing some of that business where kind of the rents are just severely off, and that is the case at this asset. Okay. The property's been owned by a lender for about 4+ years. So they're not typically the greatest operators. So if you bring someone in who's familiar with the market, knows the intricacies, understands the comps, there could still be value there. Yeah. So we're in process on that deal. We're scheduled to close in about 2 weeks.
And will that close as a bridge loan, did you say, or was that agency?
That will be a bridge loan. Yeah, there's no coverage for this deal to have gone.
Okay, to have gone agency route. Okay.
Yeah, we're about 80% occupied.
Okay.
And the rents are, the property next door is achieving rents north of $200 more a unit on smaller units. So my clients,
a clear upside. Yeah.
Yeah. My clients feel that even in a market like this, even if they miss the rents by $50, $75 a unit, and when you're talking on rents like this, that's anywhere between 7 to 10% of the total rent number. So it's pretty significant.
Yeah.
They're still in great shape on this deal. So this is a value add deal that I'd say has significant upside, and that's really why the deal makes sense. In this environment. I believe it was March 12th or March 13th, really right before kind of everything shut down. I closed on a bridge loan through a good relationship lender of ours. Yes. We did a deal at about 82.5% loan to cost at LIBOR plus 299. We had a 115 LIBOR floor, so just north of a 4% coupon on a 3-year deal.
It's amazing. Spreads were so tight just before that. It was pretty close to agency bridge. I've never seen anything like that. Super tight.
Yeah, extremely aggressive. We had multiple bids on that deal, and we executed. The happens to be the lender was great and got to the finish line with basically, really minimal change of any to terms on the transaction, just as really COVID was starting to really ramp up. Yeah. And, a deal like that in today's market probably is at 10 to 12% less leverage. Pricing is going to be at least 100 to 125 basis points wider of where it is. Yeah. And that's kind of where this Memphis deal is. we're at 475 over LIBOR with a 1% LIBOR floor. So we're 5.75 all in.
Yeah.
But to be honest, for a deal like this,
Still works.
it's a fantastic loan offer. And we hit up everyone. We worked this deal really hard.
Yeah. So that kind of leaves the last element. Are you seeing any differential between classes like A, B, and C? Are you seeing some kind of pricing differences there?
I mean, I think we've seen, in terms of just kind of cap rate, we've seen it pretty similar, across all asset types and qualities. So I think it really comes down to being more market driven, at least for the moment.
Yeah.
Again, we're only now really starting to see trades come back in. So we don't have a huge sample size of transactions that we could say, hey, this is, where we thought this was going to be pre-COVID. And, we're just now starting to see this happen. I mean, Walker Dunlop has a ever-growing and robust investment sales platform.
Yeah.
We have huge market share in the Southeast. We're big in the Carolinas. We're very big in Texas. We've recently expanded into several other markets here in the Northeast. We have guys now in San Diego, in LA, in the Northwest. So our markets, our market share and our platform has grown significantly. And just now, finally, over the last 3 to 4 weeks, we're starting to win assignments again. And you're starting to see deals go out for market and, offers due in a couple of weeks or whatever it might be. So I think the story is still to be told here.
Yeah.
What we're going to kind of see in terms of cap rate compression, because, sellers haven't really had a real reason to want to dial back what they're expecting. Collections have been strong.
Yep.
So, why give any kind of COVID, sales price? And if that's the case, we've got to see how the appraisals come. And then more importantly, on the buy side, are people going to buy deals at pre-COVID levels? Are they expecting a 5, 10, 12, 15% discount?
Yeah.
And, are we going to see eye to eye? So we're definitely seeing more transactions and transaction volume. And I'm way busier now than I was a month ago. That's for sure.
Yeah.
But to think that we're back to where we were, we're certainly not. And it's definitely going to take some time. And with the continued uptick we're seeing in many parts of the country, who knows how fast this is going to come back.
Great. So into some of the top learning questions for us. What recommendations would you have for buyers in today's market?
Don't let how attractive the debt is make a deal that's not a deal a deal. If something's not a deal,
I thought I'd never hear that from a financing broker. What is going on?
It's the truth, right? If a deal's not a good deal, doesn't matter how good the debt is, right? It's still not a deal. Debt should make a good deal, great or really good, and put your money to work, So, I tell my clients, it doesn't make me money when I say something like that, and I get it. But what does make me money is my clients being successful and coming back to me over and over again. Because when they have success, they buy more, they come back for refis, they sell, they buy again. And ultimately, I'm not here to try to make the quick buck today. I'm here to make the buck tomorrow and 10, 15 years from now and create long-lasting relationships. So I think ultimately we want everyone to be successful. If my clients are buying stupid deals, that's no good for anyone. Yeah,
agreed. What are your top 3 or 4 pieces of information to look at when getting comfortable with any market or sub-market?
I mean, listen, I think, research is key. Getting to an asset, driving the asset, walking units, driving the comps, speaking with other sales brokers and other management companies that are within the market to really understand what's going on and the specific nuances. I have clients who have very different approaches. I have clients who are extremely focused on geography and stay within, maybe it's a state, maybe it gets a lot smaller than that, and they're trying to stay within, one major city.
Yeah.
And then I have other clients who are completely agnostic to geography, not 100% agnostic, but they look for value. And so,
Okay.
you know, if you're one of those investors and you're constantly entering into new markets, there's a tremendous amount of work that needs to be done
Yeah.
to really understand that, you know, the market and what's going on, boots on the ground, you know, whether that means that you need to bring in third-party management to manage the asset for you, people who are well-heeled and experienced in that market, you know, is extremely important.
Absolutely. So on that basis, I know that you mentioned before you guys have got quite a big book. You're able to see what other properties are collecting in terms of rents. As a potential sponsor coming to you, getting pricing on debt, are you also able to offer some kind of insight as to what's going on in the rents in that market? Are they able to reach out to you and get that information from you? Or is that more only from an internal underwriting perspective?
No, I mean, I would say the best thing that we have probably are related to expenses, and we can really try to nail down through our portfolio. But yes, I mean, we definitely have the ability to pull rents. It gets to be a little bit more difficult when you're talking about size of units, you know, asset class, specific,
Yeah.
really tight submarkets, right? Because a lot of times, you know, my rent in my building and then your rent in your building, which is 3 blocks away, right?
Very
There can
different.
be a real gap, right? And we could almost be talking about two different markets, but you're looking at a comp and you're saying, wow, well, this comp is, you know, a tenth of a mile away. This has got to be a great comp. That's not always the case,
Yeah.
right? So that's why as a sponsor, when you're going down there, you got to see what that comp looks like to really understand if it's a good comp. But I mean, I tell my clients all the time, I make my money when I close your transaction, but you're not just paying me for the deal that we closed. You're paying me on all the deals that we've spoken about, that I've looked at for you, that I've sized, that finally led you to the deal that you've now won, and we're going to get to the finish line. So I always encourage my clients, if there's a deal you're taking a real run at and you want to be able to size it appropriately and understand what the debt market looks like, send me an email, get me on the phone, let's talk about the deal, send me a T12, send me a rent roll. We'll do a very quick back of the envelope, give you a sense as to where it is. And then as you get further, you know, down the road and your final 3 and you're really going to make a push to win it, we'll go back, we'll firm up the bid, we'll give you kind of firm numbers and from there. But, you know, I try to be part of my borrower's team while not being on their payroll.
Yeah.
So,
Yeah. That's
right,
a great way to do it.
right? Great way to do it. Take advantage. It's a free service. And
That's
listen,
it.
you know, we get paid. We get paid when we close loans, but we're getting paid for all that other work too. So, you know, hopefully my clients see the value in that.
Absolutely. So, what would you say the 2 most important things you've learned when it comes to financing, being in the industries, having that behind the curtain look, as a sponsor looking at different debt quotes potentially? What are some of the things that we should be diving into that are often overlooked, or just in general? Maybe there's something that springs to your mind where you think every single sponsor misses this. They should be looking at that. It could be the covenants, the terms, the backhanded money that's being paid somewhere. Like, what are we missing? What's your thoughts?
I think borrowers sometimes see the dollar signs instead of putting themselves in a situation where they can succeed. You may not succeed to the highest possible levels of what someone else might be telling you, but a lot of people that sit in the same seat that I am, unfortunately, don't always act with the utmost integrity and honesty. And I think in our business, it's just as important or more important to be working with someone that you trust to give you honest and accurate information, as opposed to, well, hey, this guy told me I can get 72% LTV, but this guy told me I can get 75.
Yeah.
And, you know, I don't know that guy from a hole in the wall, and, you know, I don't have any solid references, but he told me he can get 75. Look how much better the deal looks at 75.
Yeah.
Great. You also need to close at that 75, and you need to be able to have a working relationship with the person that you're doing business with. And a debt relationship is extremely important for any borrower. Debt,
Yeah.
Can make a good deal great, and it can make a good deal really bad.
Yeah.
A last minute retrade on a deal, is something most borrowers can't handle
Yeah.
and shouldn't have to handle. And listen, it happens, and it happens to everyone. And there can be circumstances or situations that are beyond anyone's control that get into play and so on. But the reality is get into bed with someone that you trust more so than looking for the absolute less dollar. That 1 or 2% less LTV, maybe that 5 or 10 basis points more in rate, to trust the execution, to trust the group, to trust your provider, I think is more important than trying to suck that last dollar.
Great. That's some solid advice. So you mentioned at what point they can reach out as soon as they start looking at a deal, essentially, and they're serious about buying that deal would probably be the right time to kind of get some kind of a soft quote indication. And if they're through to best and final and in the top 3, you can start firming that up and making a run for it. But how do people get hold of you if they want to get in touch?
Email, call my office, call my cell phone. Are you going to pass out contact information when you send out this link?
I absolutely will. So I'll include your email at the bottom there, if that's good.
Yeah, for sure. Yeah, you can include my phone number too. If I don't pick up, don't be offended. Leave me a message. I'm not one of those mailbox full kind of guys, so I'll actually listen to it and get back to you. I pride myself on responsiveness. I think it's an extremely important aspect of our business. I know we're talking about people's money and lots of it when you're talking about real estate transactions.
Yeah.
I don't take that lightly. I take it pretty seriously, and not being able to get a hold of someone can be extremely stressful.
Yeah.
And I try to make sure that I'm not that guy that you can't get a hold of. So in good times and bad, you'll get me on the phone.
That's great. And minimum loan size, just to make sure people are contacting you for the right things.
Sure. I'd say about $1.5 million. That's really where we we bottom out on the small balance loan size. So anything kind of sub $1.5 million could be difficult. If you have 3 or 4 transactions that are $1 million, we can pool those together, or maybe do 1 or 2 of them. That's totally fine. You start talking about, sub $1 million, $1.5 million in some of these other markets.
Gets tough.
It gets tough. And the reality is you're probably better off walking down the street, knocking on the door to the bank, walking in there and trying to create a relationship to get that deal done. You probably have to sign a personal guarantee, where, what you don't need to do on agency debt, but it's probably your best execution.
Great. Well, we'll end it over there. Thank you so much for joining me on the podcast. I really appreciate your time, and looking forward to the next one.
Likewise, Rikki, great to be with you. Really appreciate it.